Hi, and welcome to Tax Savings for Real Estate Agents and Brokers. My name's Jessica Chisholm, and I'm from Huddleston Tax CPAs. Today, we're going to talk about entity selection for your business, the home office deduction and who qualifies, the auto deduction, meals and entertainment, and then do a quick overview of tax savings with real estate ownership and talk about house flipping. When you start your own business, one of the most important things to think about when you're starting it up is what type of entity your business will be. A lot of people don't think about this, but it can have important ramifications down the road. So when it comes to choosing the best entity for your business, there are several different choices: sole proprietorship, LLC, partnership, C corporation, and S corporation. So just a quick overview of those. And a sole proprietorship is the easiest to set up. Just get a business license with the state and you're ready to go. But you do pay self-employment tax, Social Security, and Medicare on 15.3% of the profits. An LLC is a disregarded entity for tax purposes. You can be taxed as a sole proprietorship if you're a single member LLC, or a partnership if you're a multi-member LLC, or either of those can elect to be taxed as an S corporation. If your LLC is a single member LLC, you make no election and you're sole proprietor, then it's the same as the sole proprietorship, Schedule C on your 1040, 15.3% of self-employment tax on your profits. If you elect to be taxed as an S corporation, then there's a separate tax return to be filed, and I'll talk about S corporations in a minute. Partnerships are when two or more owners share in the profit and losses. If partnership is a flow-through entity, so there's no tax at the partnership level, the partners receive K-1s and they are taxed on those on their 1040. But the net income, just like a sole proprietorship, if you're an active member in the partnership, is subject to 15.3% of self-employment tax. C corporation is what people talk about when they talk about double taxation of corporations. You pay tax at the corporate level, and then if you take dividends out as the owner, you're taxed again on those dividends. C Corp files its own tax return, and there's no flow through to your personal return. S corporations avoid that double taxation, and they potentially save on self-employment tax. S corporation owners are required to pay themselves a reasonable wage, so a W-2 salary. And whatever the difference between that salary and your net income on your business is, you're able to is not subject to the self-employment tax. So that's where you can save that self-employment tax. You pay it on your wage, but not on the difference between whatever's left over as net income. Also, for 2018 is the 20% pass-through deduction. So this would apply to sole proprietorships, partnerships, S corporations, and LLCs that are not C corporations. Basically, you get a 20% deduction on page 2 of your 1040, 20% of the net income of your pass-through business. There are some more complicated rules regarding that, as like which industries qualify for the full deduction and what the limitations are, as well as a wage requirement in some cases. So if you are needing more information about the 20% pass-through deduction, you should definitely contact your tax professional. I want to talk about the home office deduction a little. I think a lot of realtors are able to take advantage of the home office deduction since they don't necessarily need a separate office outside of their home in order to work. For the office to qualify for the home office deduction, you must meet one of the following requirements. It must be your principal place of business, or a place where you meet clients, or an office that is a separate structure not attached to your house, or a place where you store inventory. So there's not going to be a lot of inventory for realtors, but you could have things like brochures, business cards, things like that that you store in like a storage room. So the way you would calculate that, there's multiple ways you can calculate it, but the most common way to do that is the square footage method. So for example, if you have a 2,500 square foot home and your home office is 500 square feet, then your home office allocation is 20%. So this means you're able to deduct 20% of your mortgage interest, property taxes, insurance, utilities, and basically anything it costs to keep your house up. The home office must be 100% business use. So it can't also be a guest room and have a bed in it. It needs to be 100% for the use of your business. If you use your garage to store inventory or 100% work use vehicle, then you may be able to deduct that space as well. You may also elect to use the simplified method, which allows you to deduct $5 for every square footage of your home office. This is capped at $1,500 a year though, so you want to do a comparison to see which way works best for you. Okay, then there's the auto deduction. That's really important for realtors because you're driving around a lot. You definitely want to track all of your miles. You can keep a logbook in your car. You can use an app on your phone, however you want to track it, but you need to track business miles and total miles for the year. And then when it comes time to deduct it, there's two different ways. There's the standard mileage deduction and the actual expense method. The standard mileage deduction for 2018 is 54.5 cents per mile. And business miles include trips to see clients, to job sites, to houses you're showing, post office, banks, office supply store, anything you're driving to for business. Business miles do not include trips from your home to your office. Those are considered commuting miles and do not count unless you make your home office your principal place of business. Then every time you leave your house for business, it counts as mileage. The actual expense method is when you deduct the business portion of the actual expenses used to operate your vehicle. So you would track not just your miles, you still need to track your miles, but also how much gas, repairs, oil change, loan interest, new tires, everything it costs to operate your vehicle. And so you're still tracking those miles because you need to determine business use if it's not 100%. One thing to think about with the actual expense method is you can't switch back to standard mileage once actual is used. So a time when the actual expense method might be advantageous is if you're changing cars a lot. So if you buy a new car every 2 or 3 years, you're going to get the depreciation write-off for the actual expense method that you're not going to get with standard mileage. If you're driving around an older car that's not worth much, then standard mileage deduction's often going to be the best. So you should do a comparison to see which would work for best for you and for long term. Meals and entertainment. So meals and entertainment changed with the tax legislation in 2018. So certain meals are still 50% deductible on your tax return. Starting in 2018, meals that are for the convenience of the employer are no longer 100% deductible, but are now 50% deductible. And meals for travel remain deductible at 50%. Also for 2018, starting in 2018, business entertainment is no longer deductible. So if you're used to taking your clients to baseball games or to other entertainment type events, that's no longer deductible at all. In order to qualify for the deductions that are left, you must be conducting a legitimate business discussion. So you need to be able to answer the following questions. Who was entertained? Where did the meal take place? When did the meal take place? Why did it take place? And how much did it cost? So just take the receipt from the restaurant, flip it over, write on the back who you were with and what you were talking about, and then save that receipt in case you're audited. So now I just want to do an overview about different tax savings with your personal residence. This is, I think, important for realtors to know so that they can talk to their clients about this information. Items that are deductible on Schedule A of your 1040 are mortgage interest, points paid on the loan, and real estate taxes. So new for 2018, mortgage interest is now deductible on the first $750,000 of a home mortgage debt for the first and second home combined. This is down from $1 million plus another 100,000 for HELOCs. There's no more deduction for HELOCs if they're not for improvement of the home. Pre 12, 16, 17 mortgages are grandfathered in and can still deduct on the first $1 million of home mortgage debt. Points paid on a new loan are deductible in the year incurred. A new house, loan for a new home. Points paid on a refinance are amortizable over the life of the loan. And then real estate taxes, new with the tax legislation for 2018. The real estate tax deduction is combined with the state and local tax deduction and capped at $10,000 total. There's the principal residence exclusion when you're selling your main home. You may be able to exclude up to $250,000 if you're single or $500,000 if you're married filing joint. If you have owned the home for at least 2 of the last 5 years, ending on the selling date, and you lived in the house as your main home for at least 2 of the 5 years, ending on the date of sale. And also during that 2-year period, you can't have also excluded the gain from another home. So this did not change with the new tax legislation. I want to talk a little bit about rental income as well. That's important in the real estate industry. When you're reporting a rental house on your 1040, report income when it's received, your cash basis on your 1040. Security deposits that are refundable are not included in income until they're no longer refundable. If you rent your home for less than 15 days in the year, you do not need to report the income. There's also discussion about whether rental properties will qualify for the new 20% pass-through for the business deduction on the new tax legislation, and I don't have an answer yet as to whether it will qualify. So consult your tax professional about whether your property will qualify or not. For rental expenses, you need to deduct them in the year paid. And you can start deducting them whether there's a tenant or not. You do not deduct uncollected rent because, again, cash basis taxpayer, you never declared the rent as income in the first place because you never received it, so there's no deduction for uncollected rent. When you have a rental property, repairs can be expensed in the year incurred. Improvements are capitalized and depreciated over the useful life. So repairs would be things like painting, fixing the floors, fixing leaks in the roof, and replacing broken windows. Improvements would be additions to the home, new roofs, large repairs to the home. Some rental expense examples would be advertising for a new tenant, cleaning when people move out, utilities that you're paying for, homeowners insurance, real estate taxes. And there's no $10,000 limit for real estate taxes on the rentals. Mortgage interest, and then travel to check on your home. So depreciation, I touched before on the property that needs to be capitalized and depreciated. The building itself needs to be capitalized and depreciated. Land is not depreciable. New appliances, new carpet, new furniture if you're renting it furnished, if you add something like a fence, and other additions and improvements. So they would be depreciated over their useful life. So with rental losses, if you actively participate in the rental, then rental loss is less than $25,000. There's no limit. If you actively participate and the loss is more than $25,000, it is limited to $25,000 a year, and the excess carries over to future years. If you do not actively participate, then the loss is only deductible to the extent of other passive income. So an example of a rental loss, you have active participation in a rental, it lost $30,000. You also have additional passive LLC income on a 403(k)(1 of $15,000. So you're able to offset your rental loss with that passive LLC income for a net passive loss of $15,000 for the year. The losses do phase out based on your income. So if your AGI is less than 100,000, you can take the full $25,000 loss. If your AGI is between 100,000 and 150,000, then you can take part of the loss. So 50% of the difference between the 150,000 and whatever your AGI is. And if your AGI is over $150,000, you cannot take a loss at all. It all carries over to future years. And if your AGI never allows it, then you take that loss when you sell the property. Some realtors and their clients are into flipping homes. So I want to talk briefly about that. Flipping houses can be taxed either as ordinary income or capital gain income. You don't get to choose. It depends on the circumstances surrounding your flipping. Ordinary treatment is ideal when you have a loss because you're able to take the full loss and it'll offset your ordinary income. Capital gain treatment is ideal when you have gains because there's a lower tax rate. So when it's considered ordinary income, you report it on Schedule C as if it's a business and it's taxed at your regular tax rate. You'll owe self-employment tax on any income that you earn and pay a 15.3% tax on that. Self-employment tax can be avoided by creating an S corporation if you're in the business of flipping. That's something to look into. And the Schedule C or the S corporation would be able to take the 20% pass-through deduction that I talked about earlier under the new tax legislation. Capital gain treatment is reported on Schedule D and taxed at capital gains rate, so there's no self-employment taxes. But if you do have a loss, it's limited to $3,000 per year. So there's a fine line between whether it's considered ordinary income or capital gains. The IRS gives a little bit of guidance, but nothing, there's no checklist or anything to go over to see exactly what you qualify for. So the IRS may consider it ordinary income if real estate investing is your main source of income. So if it's all you do, it's a business. If you own or sell multiple properties during the year, maybe you still have another W-2 job, but you are flipping on the side, but you're doing it multiple times a year, it's going to be considered a business. If you have significant sweat equity, so if you're going in and doing all the repairs yourself, or if you're owning the properties for short periods of time. So if you're flipping them every 60, 90 days, it's going to be considered more of a business. The IRS may consider it capital gain income if you own and or sell only 1 or 2 properties a year. If you hold the properties for long periods of time to let them appreciate with the market, and if you don't make significant improvements through sweat equity. So that was all I had to talk about today. If you have more questions, feel free to contact us at our below contact information and visit our website. Thanks for attending.